Changing established medical routines is never easy, and it often takes years of persistent effort. Sales cycles in the medical device world are notoriously long, with multiple layers of decision-makers and budget approvals. Breaking into this market is tough, especially for a small company with limited resources. Financially, Endra is burning through cash at a rapid pace. Revenue remains minimal, and the company's cash runway is short, meaning they'll need to raise more money soon just to keep the lights on. That means more dilution for existing shareholders is almost inevitable as they seek additional funding. Each new round of capital raises chips away at the value of current shares. The stock trades as a penny stock for a reason. There's a huge execution risk here. The company's future depends on its ability to turn promise into real-world adoption and sales. Endra must prove it can actually sell the TIAS system at scale, not just in pilot programs or small trials, but in meaningful numbers that move the needle financially. Until that happens, this remains a highly speculative play. The risks are significant, and the path to profitability is far from guaranteed. For new investors, I'd call it a strong avoid. There are simply too many hurdles and too much uncertainty at this stage. The risk of failure is just too high, and there are safer opportunities elsewhere in the medtech space. If you're already holding shares, keep a close eye on whether Endra can generate real sales traction. Otherwise, it's best to steer clear for now. My verdict: avoid. Let's talk about Workhorse Group, ticker WKHS, a company that's been trying to carve out a niche in the electric vehicle world, specifically with commercial delivery vans. While the EV space is full of big names and bold promises, Workhorse has always positioned itself as a scrappy underdog, hoping to disrupt the last-mile delivery market with its electric solutions. Early on, there was real excitement around Workhorse, especially when they were in the running for the massive USPS contract. But losing that deal was a huge blow, and since then, the company has struggled to regain its footing or deliver on its early potential. The road hasn't gotten any easier. Recalls have forced them to pull vehicles off the road, production delays have slowed their ability to scale, and the company's high cash burn rate has raised serious questions about its long-term viability. New management has stepped in, promising a turnaround and a fresh approach. But let's be honest, the competition is absolutely fierce. Giants like Ford and Rivian are pouring billions into their own electric commercial vehicles, and they have the resources, scale, and dealer networks that Workhorse simply can't match right now. Workhorse does generate some revenue, but the harsh reality is that they're losing money on every vehicle sold. Their cost structure is out of balance, and until they can achieve scale and efficiency, profitability remains a distant goal. To keep the lights on, Workhorse has had to raise capital multiple times, which means issuing more shares and diluting existing shareholders. For investors, that's